Gold didn't just dip, it blinked. And when gold blinks at record highs, history says, you pay attention. Here's what just happened. Gold slipped back below $40,100 an ounce after flirting with record territory. Strong U.S. data hit the tape. Jobless claims fell. Retail spending surprised to the upside. At the same time, Greenland trade tensions eased after conciliatory comments from Trump. Risk appetite flipped almost overnight. Stocks ripped, bonds sold off, and gold futures got slammed. Fast, violent, visible. But here's the part most people are completely missing right now. Physical premiums didn't collapse. Central bank buying didn't stop. Long-term holders barely moved. If you're holding gold, watching gold, or stacking quietly, this moment matters. Not because price dipped, but because a very specific pattern just activated. If you're seeing this now, you're ahead of the crowd that will react emotionally tomorrow. Your job isn't to predict the next tick. It's to understand what this move is actually telling you about the next 3 to 6 months. By the end of this, you'll know whether this was a reset or a warning. So let's walk through it. And before we go deeper, if this is your first time here, subscribe. This channel doesn't chase headlines. We read flows. We watch what smart money does when nobody's looking. This is for people who want to understand markets, not react to them. If you're tracking gold this week, type "watching" in the comments. Mark the moment. You'll want to remember where you were when this pattern showed up. Now, here's the transition. Gold hit near record highs. Some quotes north of $4,800, others brushing $5,000 depending on the contract and exchange. Then the data hit. Stronger than expected U.S. numbers flipped sentiment. At the same time, geopolitical tension cooled faster than anyone expected. Risk came roaring back. And gold? It got crushed. Dropped hard. No hesitation. That's the layer everyone's talking about. Here's what they're not telling you. This wasn't physical selling. This was leverage getting flushed. Futures-driven, positioning-heavy flow. The kind that moves fast and looks dramatic, but doesn't say much about real demand. If this were true capitulation, you'd see it somewhere else. You'd see warehouse stocks flood the market. You'd see premiums in Asia collapse. You'd see central banks step back. You don't. And that's the first clue. There's a mechanism behind this kind of move, and once you see it, you can't unsee it. I call it the relief rally trap. Here's how it works. Macro fear builds. Geopolitics, recession risk, banking stress, currency debasement. Pick your catalyst. Gold climbs. Positioning gets crowded. Everyone's watching. Then something eases. A comment, a data print, a policy response, a rumor of calm. The pressure valve opens. Risk appetite surges. Equities rip. Gold sells off fast. Futures get slammed. Headlines scream that gold lost its safe haven bid. But here's the trap. The pressure released, but the pipe isn't empty. If underlying physical demand is still strong, if central banks are still buying, if jewelry demand in India and China is intact, if coin and bar sales remain steady, the sell-off is a reset, not a reversal. But if physical demand was already weakening before that relief rally hit, that's when the drop keeps going. That's when the trap closes. This pattern repeats again and again. In 2016, Brexit fear peaked and gold ran to around Paul 375. The Fed signaled stability, equities rallied, and gold dropped to 1,250 in about 6 weeks. Physical buying never stopped. Within 4 months, gold was back near 1,350. In 2020, gold surged to about 2,070s after the COVID shock. Vaccine news flipped sentiment. Gold slid to roughly $1,770 by early 2021. Central banks kept stacking. By 2024, gold was trading well north of $2,400. In 2023, the banking crisis pushed gold above $2,050 after SVB collapsed. The Fed stepped in, fear eased, and gold pulled back near $1,940 in 2 weeks. Physical premiums stayed elevated. Within 2 months, gold was testing new highs again. The fastest drops are often the least informative because they're driven by leverage, not conviction. Right now, we're in that exact moment. The valve opened, futures got flushed, positioning got trimmed, but the real question isn't price. It's whether underlying demand is still there. And to answer that, you have to look where most people aren't. There's a second mechanism stacked on top of the first. I call it the liquidity shakeout. When gold trends higher, leverage builds. Retail piles in. Managed money stretches positioning. Everyone's riding the wave. Then a surprise hits. The dollar spikes. Yields jump. Margin calls start rolling. Leveraged longs get forced out. Not because they lost conviction, but because they lost liquidity. Strong hands don't move. Central banks, family offices, long-term stackers barely notice. Weak hands are gone in minutes. That creates a false sense of clarity on the chart. Price drops, volume spikes, and it looks like capitulation. It isn't. It's musical chairs. Imagine holding physical gold in a vault that you bought at $1,800. You're up huge. You believe in the thesis. Then gold drops 150 in 2 days on a hot jobs report. You don't sell. You might not even check the price. Now imagine you're long hundreds of leverage futures contracts. Same drop, same 2 days. You don't get a choice. You're liquidated. That's the shakeout. And this is the key point most people miss. If you're only watching price, you're watching the wrong battlefield. Price tells you what happened. Positioning tells you who moved. Open interest tells you whether they're gone or just adjusting. Premiums tell you if real buyers still care. Right now, we're seeing leverage trim. We're not seeing structural exit. And that distinction matters. When you connect these two mechanisms, the relief rally trap and the liquidity shakeout, you get the full picture. Sentiment flips, gold drops, leverage amplifies the move. If the relief rally sustains, if the dollar grinds higher, yields stay elevated, and risk appetite holds, then the shakeout can turn into something bigger. That's when conviction gets tested. That's when physical premiums soften. That's when central bank buying pauses. That's when structure actually starts to crack. But we're not there yet. Here's what the signals are saying right now. Open interest on COMEX is down, but not collapsing. Roughly 8 to 12% off the peak. That's trimming, not an exodus. Asian physical premiums in places like Shanghai and Hong Kong are holding in normal ranges. Mid-single-digit percentages over spot. That's healthy demand. Central bank buying hasn't slowed. According to the World Gold Council, central banks added roughly 180 to 200 metric tons in late 2024. No headlines about pauses. No signs of capitulation. The dollar is stronger, but not decisively so. It needs to hold elevated levels for more than a few sessions to signal a regime shift. Intraday volatility is elevated, but not extreme. We're seeing noise, not panic. None of these are screaming, "Get out." They're whispering, "Pay attention." So, here's where we are. Gold blinked, leverage got flushed, sentiment cooled. The structure is still intact. That doesn't mean the pullback is over. It doesn't mean we bounce tomorrow. It means the question isn't buy or sell. The question is whether this is distribution or a reset. Distribution shows up as collapsing premiums, sustained drops in open interest, central banks stepping back, and volatility compressing at lower prices. A reset looks like leverage exiting, open interest stabilizing, volatility spiking, then fading, and physical demand holding. Right now, we're seeing early signs of a reset. The next 7 to 14 days will confirm it. And this is the real test the market just handed you. Can you tell the difference between a sentiment-driven flush and a structural breakdown? Can you watch flows instead of price? Because gold doesn't warn loudly. It whispers, then it moves. The whispers right now are mixed. That's where most people make their worst decisions. Your job isn't to know what happens next. Your job is to know what to watch. If price chops and volatility compresses, that's stabilization. If the dollar fades and premiums hold, that's confirmation. If open interest stops dropping, the flush is likely done. There are a few paths forward. One is a shallow reset, with price chopping and structure holding before another test higher. Another is a deeper shake, where strength in the dollar and risk assets pressures gold further and tests conviction. The third is a surprise bid, where physical demand reasserts itself and gold snaps back faster than anyone expects. No predictions, just structure. If you're a trader, respect the volatility. Wait for stabilization. Don't fight momentum. If you're a long-term holder, remember why you own it. Structural theses don't play out in straight lines. If you're stacking, this is background noise. You're buying ounces, not headlines. Here's the bottom line. Gold blinked. Headlines screamed. Leverage flushed. but the structure is still holding. If you're watching flows instead of noise, you're in the group that survives cycles. Drop a comment and tell me, reset or warning. And if you've lived through one of these flushes before, share what you learned. Gold doesn't shout, it whispers. You just heard it. Now, let's see what it does next.